Thank you very much for having me on and for the opportunity to present. Excited to tell you a little bit more about Gate City Capital, and then also walk through our investment choice today, which is Unit Corporation. And so to introduce the firm, Gate City Capital is a Chicago-based investment management firm. We seek to provide our investors with attractive, absolute long-term investment returns through the construction of a concentrated portfolio focused on U.S. microcap companies. We construct our portfolio through in-depth fundamental analysis focused on the risk and reward of each investment. And we look for companies trading at a deep discount to intrinsic value. And we also focus on the potential downside of each investment in order to provide an attractive or an appropriate margin of safety. And the firm's name and logo, I'm originally from a small town called Glendive, Montana, which is nicknamed the Gate City. And so in naming the firm, decided to pay reference to where I grew up. Next slide provides our team. It's myself and Chad Gorse is our CFO and COO. And then we have both Nicholas Bodner and Harry Sowers as research analysts. Slide 6 shows our investment philosophy. We have some key investment tenets. We focus on buying companies and not stocks. We think of shares as a proportionate ownership of that company, and think of buying a share of that as similar to buying the entire company. We have a long-term investment horizon. We look to invest for a minimum of 2 years when we make any investment. We focus on downside risks and margin of safety. We look to limit the potential capital loss of any investment through an analysis of what can go wrong. We take the time to know the company. We think that information is not free, and by doing the right amount of research work, we can obtain an informational edge over many other investments. We look to evaluate the management team and identify their incentives. We typically look to meet with management teams in person before making any investment. Our portfolio is concentrated. We look to hold under 20 positions. And we also have an alignment of interests. Both myself and the other members of the team have a significant portion of their net worth invested alongside our investment partners. And going to slide 7, it shows the types of companies we look at. We focus on companies with market capitalizations between 10 and 500 million. There's no absolute cap, but find that's our sweet spot for investing. We look for companies that are headquartered in either the United States or Canada. We like to keep it to areas that we're both familiar with the language and can travel to relatively easily. We look for companies with understandable business models. We're relatively agnostic across industries, but have tended to avoid a lot of tech companies and also financial companies, given some of the investment attributes that we look for. We look for companies generally with lots of debt, or lots of cash and little debt. So right now we have 17 portfolio companies, and 14 of the 17 have net cash balances. If a company does have debt, we like them to have both the willingness and ability to repay that debt. We also look for companies with ownership of assets. This can include land, buildings, and equipment. And we find that's attractive both from a margin of safety standpoint and can also be beneficial in an inflationary type environment where we're looking for the value of those assets to also increase in an inflation environment, which creates a natural hedge for any of the companies in our portfolio. And the next slide, slide 8, shows our valuation process. We have a philosophy that the value of a business is derived from the amount of cash that the company is able to generate. And that's where a lot of our focus is on our research side. From a valuation standpoint, we value all of our companies utilizing a discounted cash flow analysis. And with the target price or intrinsic value of the company gained by adding the projected future cash flows of the company with an appropriate discount rate. Our discount rates generally start at 12.5% and can be adjusted upward or maybe downward slightly depending on the nature of the business. We supplement the DCF with a comparable company analysis and to understand how the company's peers are also being valued in the market. And we also utilize a floor value analysis. And this is used to estimate what the business could be worth in the event that all the company's assets are liquidated in an orderly fashion. Slide 9 provides our portfolio construction process. We size each of our positions so the companies with the most attractive risk and return metrics have the highest weights in the portfolio. From a construction standpoint, again, look to hold fewer than 20 positions, maximum position size of 20%. And we weight our companies based on utilizing both the DCF analysis or intrinsic value to understand our potential upside, and then the floor value or liquidation type analysis to understand our potential downside. For the upside, we look for companies with at least 50% upside for the intrinsic value versus where shares are currently trading. And we like little to no downside based on liquidation value. And we compare the ratio each week in terms of where stocks are trading for a ratio of upside to downside. We realize that's a linear relationship, and perhaps the weightings, or at least we hope the weightings or probabilities of the upside scenario are higher than the downside scenario. But I also tend to think that analysts can be overly optimistic in their projections. And so look for companies with the highest upside to downside ratio and weight those. So companies with the best ratio have the highest weights in our portfolio. And the next slide shows our historical returns. So I founded the firm initially in 2011, and thus far we're pleased to have been able to deliver positive, attractive absolute returns for our investors. We do not look to beat or manage to any outstanding index, but do feel that by following our investment strategy and process, that then provides us with the highest probability of performing well versus any index over an extended period of time. And we're all excited for the future and realize there's a lot of time and a lot of work to do going forward, but are pleased to have been able to deliver good absolute returns thus far to our investors. So that completes our high-level overview of Gate City Capital Management. The company I'm going to highlight today is one of our largest holdings. It's called Unit Corporation. The ticker is UNTC, Uniform November Tango Charlie. Unit Corporation is an integrated energy company that operates in two segments. Unit Petroleum owns and operates oil and natural gas producing assets in the United States. And Unit Drilling owns and operates 21 onshore drilling rigs. The company previously had a third segment, Unit Midstream, which consisted of a 50% ownership in Superior Pipeline. They continue to own that, but it's no longer consolidated within the company's results, and so is not a direct operating segment at this time. But I'll talk about it more. In Superior Pipeline owns natural gas pipelines and related infrastructure within the U.S. It was founded in 1963. It's headquartered in Tulsa, Oklahoma, has 788 employees. And the company currently has a market cap of approximately $588 million. They have zero debt outstanding. The cash balance is just over $115 million. And after quarter end, Unit made an asset sale and should be getting an additional $43.5 $7 million in cash after quarter end, or an adjusted enterprise value of just below $430 million. For the last 12 months, it generated $114 million of adjusted EBITDA and $87 million of free cash flow. The company emerged from bankruptcy and began trading in very early in 2021, and thus far has provided a good share price return since exiting bankruptcy. Turning to slide 12, it provides our investment thesis. Unit owns numerous energy related properties and equipment that we think will benefit significantly from current high oil and natural gas price environment. After declaring bankruptcy in May of 2020, Unit shed over $650 million of debt through the bankruptcy process, installed an experienced management team focused on generating free cash flow, while also cutting operational costs and capital expenditures and divesting non-core assets. This is apparent as of Q2 2022. Unit had sold over $100 million in non-core assets, and again expect to receive a net of $43.7 million after the end of Q2. And combined with very strong free cash flow and asset sales, Unit has utilized that free cash flow appropriately. They've paid down all outstanding debt and now have a net cash balance of $115 million. So basically the balance sheet has been reversed. It has also repurchased over $65 million in common stock since emerging from bankruptcy at what we think are very attractive valuation levels. And we continue to think Unit is attractively valued based on our 2022 forecast. Unit trades at around 3 times enterprise value to EBITDA and has a free cash flow yield based on the market cap, not the enterprise value, of over 22%. So we still see it as very attractively valued. And just going back, we have a price target of it per unit of just over $90 a share, which still provides 51% upside. And next, to give you a little more information on the company's 2 segments, Unit Petroleum owns and operates oil and natural gas assets in the continental U.S. The key properties are located in Texas and Oklahoma, with other assets across a number of other states. The company owns almost 1,500 producing wells across 270,000 acres of land. And just from a production standpoint, over the last 12 months, Unit's generated over 1.5 million barrels of oil, 2.5 million barrels of natural gas liquids, and 27.4 million MCF of natural gas, equivalent to 8.6 million barrels of oil equivalent, or BOE, and it produces around 23,000 BOE per day. Oil reserves, 67.3 million barrels of oil equivalent, and it's broken up approximately 13% oil, 32% natural gas liquids, and 55% natural gas. The company's revenue over the last 12 months, revenues of $305 million, operating costs of just under $100 million, and we'll talk about it more, but hedging cash flows have been a negative drain of around $89 million. So we utilize the MPC adjusted EBITDA of approximately $120 million over the last 12 months, with approximately $20 million of CapEx for $100 million of free cash flow from this segment alone. So this slide highlights a lot of the high-level numbers I provided earlier, but Unit realized an average price of about $40 per barrel of oil equivalent, with operating costs of just over $11 BOE equivalent. So we think it's very profitable in a number of commodity price environments, with approximately $100 million of free cash flow generated over the last 12 months. And Unit has a legacy hedging program. The vast majority of the hedging program was enacted as the company emerged from bankruptcy, and that was in accordance with agreements with lenders. More recently, in Q2 2022, Unit layered on additional hedges at what we think are attractive prices, with oil in the range of $75 to $80, and natural gas, they put on some hedges above $9 an MCF. But to summarize, through the second half of 2022, Unit is essentially 100% hedged in both oil and natural gas, with oil around $55 and natural gas right around $4.75. In 2023, the company has 58% of their oil hedged, or we approximate 58% of production hedged just below $50 a barrel, and just over 50% of their natural gas hedged at just over $3. And so they are underwater on a lot of their hedges, but despite that, with their low cost of production, they're very profitable at their hedge prices, which minimizes the risk of what happens to the economics if commodity prices fall, while still retaining upside. They're unhedged in their natural gas liquids portfolio, and also have potential upside should prices remain where they are in 2023, with nothing hedged in 2024. And in terms of our forecast for 2022, we think we'll see improved results. Revenues north of $330 million, adjusted EBITDA of around $135 million, and forecasted free cash flow of $115 million. We forecast a decline rate for the company's assets of 16%. And in terms of commodity price environments, we approximate the strip pricing with a little discount, forecasting oil prices to fall to $65 by 2024, and natural gas prices to fall to $4 by 2024. So listeners might have different views on what the commodity prices hold in the future, but to give you an idea of what assumptions we use in formulating our fair value analysis. The next segment is Unit Drilling. Unit Drilling operates 21 onshore drilling rigs across the United States. The key assets in the company's fleet are 14 proprietary Boss drilling rigs. They're known in the industry as super spec drilling rigs. They're new additions to the fleet, with the last 3 of the 14 delivered in 2019. These rigs cost over $20 million to build at the time, and industry participants estimate that today building a new super spec rig would cost in excess of $30 million. Unit's currently operating 17 rigs, including all 14 of their Boss rigs and 3 of their SCR rigs. Those are lower spec rigs that are legacy assets of the company. And the utilization of the company's fleet has expanded from operating around 10 rigs in 2020 to 17 today. Over the last 12 months, Unit Drilling generated over $100 million in revenue and $18 million in EBITDA. And the approximate numbers behind that, the rigs in the most recent quarter generated $21,300 per day in revenue, and that was offset by $17,300 per day in costs. So the segment's been EBITDA positive throughout the downturn. And I want to note and highlight that the market for super spec rigs has gotten very tight over the last few months. So as the rig count remains far below historical levels, but has been advancing, and especially for super spec rigs, which are in very high demand. Recent day rates for super spec drilling rigs exceed $30,000 per day and have approached $35,000 per day. The average contract length for Unit's fleet is approximately 6 months, and we think the $21,300 per day rate that was seen in Q2 begins to approach $30,000 per day or higher as we get to year-end 2022 and beyond. And to provide an illustration of what this means for economics at $30,000 per day, which is likely below where spot prices are. Unit drilling generates $200 million in revenue and approximately $100 million of EBITDA. And we think a lot of this flows to free cash flow and estimate CapEx for the segment between $10 and $20 million. So it's a much more recent phenomenon, but our outlook for unit drilling has improved dramatically. And looking at the revenues, EBITDA and cash flow that the segment can generate, we again think that this segment could be valued at the current enterprise value for the company if current environment remains in place. And next, I'm going to talk about midstream. Well, it's formerly the midstream segment, which is units 50% ownership in Superior Pipeline. This segment, again, was fully consolidated until Q1 2022, at which time unit deconsolidated the segment, and it currently has practically no value shown on either the balance sheet or income statement. Unit formed Superior Pipeline. The Superior Pipeline was formed in 1996. In April 2018, Unit sold 50% of Superior to two private equity groups for $300 million, which valued the segment at a total of $600 million. And so that provides an indication of what value was in April 2018. Unit continues to own 50%. And the asset base has almost 4,000 miles of natural gas pipelines, a number of natural gas treatment plants, as well as processing plants, gathering systems, and compression systems, with assets based in both Oklahoma, Texas, Kansas, as well as the Marcellus Shale in Pennsylvania. And it's important to note that while Unit has a 50% equity interest, the terms of the partnership likely mean that Unit's actual economic interest will be less than 50%. And this was the reason for the deconsolidation. Based on their agreement, distributions from Superior are split 50-50 between the partners through 2021. And the split after 2021 is predicated on Unit having spent $150 million to drill oil and gas wells in geographies where Superior Pipeline operates. Their Unit did not fulfill that obligation, and due to that, 58% of that spending shortfall, or at the time $72+ million, would be distributed to the partners before distributions are again split 50-50 with Unit. So thus far in 2022, the partners have received 100% of the distributions, and that's reduced the current shortfall to $48 million. And we expect the partners to receive approximately $10 to $12 million per quarter, and expect this shortfall to be eliminated by Q1 or Q2. And in addition to the split of the partnership interests or the distribution payments, Unit's partners also have the right to force the sale of Superior in April 2023 and have a 7% preferred return on their $300 million investment. And of note, this preferred return is reduced by any distribution payments. So the current preferred return based on a 7% IRR is $353 million. And we estimate if distributions are received by the partners as expected, that will be reduced to $330 million by April 2023. So in the event that the partners choose to liquidate, they would receive the first approximately $330 million in proceeds, with unit receiving the residual. So we think of this ownership as a slightly in the money call option, which could be very valuable if the partners choose to sell or choose to enact the sale of the company, and then valuation units proceeds or units valuation will be based on the actual price received by the partnership through a sale process. So the bottom table there provides a graphical illustration of the distribution split various scenarios. And as we think about valuation of Superior Pipeline, the company has historically been very profitable. In 2021, it generated almost $340 million of revenue, adjusted EBITDA over $50 million, and free cash flow of $28 million. Superior also has an unlevered balance sheet, basically with very close to zero net debt, and has since 2021 has generated a lot of cash flow and returned $57 million to its partners, with the unit receiving half of those in 2021 and all those going to its partner. And so we think units value here could it varies significantly. I think we're conservative and place a valuation of $50 million on unit stake. Here's in the market trade between 8 and 10 times EBITDA. If you put an 8 times multiple on 50 million of EBITDA, you get a valuation worth of $400 million, which would provide in the range of $75 million to unit shareholders. But we note there remains a large amount of uncertainty regarding the potential economics to unit. And slide 19 summarizes our financial projections and valuation for Unit Corporation. We aggregate our forecast for Unit Petroleum and Unit Drilling, along with approximately $24 million in annual SG&A expenses to project consolidated financials. And again, for valuation purposes, we remove any historical results or future results for Superior Pipeline and value them at $50 million. So, in summary, Unit Petroleum, we have generated $334 million in revenue and $134 million in adjusted EBITDA in 2022. Unit Drilling, $146 million in revenue and $41 million in adjusted EBITDA with corporate expenses of $24 million. And we utilize a 12.5% discount rate to obtain a target enterprise value of $677 million. And we add to that $116 million in net cash, $44 million in cash from proceeds from an asset sale, $50 million in value for Superior Pipeline, or target equity value of almost $900 million, or approximately $90 per share. And this represents a 51% upside to the current share price. And slide 20 provides just an overview of our projections and where we see the company going and the financial results in 2022 and beyond.